The morning star pattern. The morning star pattern is another form of a bullish bottom reversal pattern. A morning star candlestick pattern can successfully predict or explain trends in price movements in the case of currency trading, equity, securities, or financial derivative. It's a warning signal which appears when there is a weakness in a downtrend, while the first candle is a bearish candle and with a large body, and the third candle has a lighter body but a bullish candle, and the middle candle can be bullish or bearish but with a short body. So here is an example of the morning star on the chart of GBP GPY. So on a daily chart. So as you can see, there is a bearish trend, and then there is a bullish trend. So this pattern is a reversal pattern, and it reverses the direction of the market. So once a morning star pattern is spotted, investors may follow it closely and take advantage of a positive trend reversal situation. The morning star pattern, in conjunction with other technical measures, helps investors execute positive buying decision for profitability. As soon as the trend reversal takes place, we size assessments of the candlestick to determine the reversal potential in the trend line. So two other important aspects of the morning star pattern are the gap up and the gap down openings. So the gap up opening is an indication of the buyer's enthusiasm. This means that the buyers are likely to purchase the currency at a price higher than the close of the previous day. As a result, the opening price of the currency for the next day is more than the close for the previous day. A situation like this results when the position of the currency is so favorable that the buyers agree to purchase this currency at any price. A price increase is experienced, and this is referred to as a gap up opening. So gap up openings are always bullish in nature. On the other hand, when the buyer gets more enthusiastic, a gap down opening occurs. To elaborate this situation motivates the buyers to sell at the price lower. So Forex traders understand morning star patterns as a variation of the bullish engulfing pattern. The only difference is that the middle candle is expected to be low range candle, such as the doji pattern. In a non-Forex morning star pattern, the middle candle must be located at an isolated point with respect to the other two candles. In this case, the second candle may be either bearish, bullish, or doji. However, the second candle is not an inside bar or harami candle. In the non-Forex arrangement, the third candle opens at or below the second candle of the pattern. The third candle must not engulf the second candle and must leave it isolated. Trading correctly with morning star pattern is dependent on identifying the context accurately. Once a downtrend is established, the morning star candlestick pattern can be traded with success. That being said, guys, thanks for watching. See you on another video with another technical analysis.